2023, of course, were interest rates and macroeconomic uncertainty from a credit performance standpoint. Now, while we saw overall net downgrades in the issuance that we track, I would say it varies by sector. So some of the sectors that experienced more stress, for example, consumer discretionary was one, and then some of the sectors that tend to be a bit more sensitive to interest rates, such as real estate. And in aggregate, the US had the highest rate of downgrades, but that is really also a reflection of the composition of the US bond market, which is a higher representation of spec grade issuers overall. We would see continuation of some of these credit stresses. We are expecting on a trailing 12-month basis, defaults, for example, in the US by September would hit 5%. And by September, trading 12-month defaults for Europe would be around the 3.75% range. What we see is continued trends and themes going into 24, rates, of course, but also the increased uncertainty and volatility. It's not just about the macro fundamentals, but we also have almost half the world's population voting in elections this year, and the threat of escalation in the Middle East.